I want to share with you today some value stocks offering higher risk but higher reward. The risk is underperformance, the reward is long-term gains. Nowadays, growth investing is the buzz phrase and value investing is slowly going out of style. But it is still a reasonable strategy, especially when growth stocks have run up so much in recent years. Sometimes the way you make the most money is going against the popular trend. I want to share 10 stocks that are trading at lower valuations compared to their pricier counterparts due to slow expected growth and high business risk. Historically, value stocks have outpaced their growth counterparts over the long term in most studies, but this is not always the case, so keep that in mind. Mispricing is where the success of value stocks comes into play. Also, high earnings expectations due to higher risk can cause volatility and therefore opportunity. There are also sector biases. Think of the popularity of the tech sector, which can keep its momentum going even though the industry may be highly overvalued. The vice versa can happen too. The 10 value stocks I want to present to you have low expected growth rates but are profitable, therefore offering a cheaper valuation that could create big returns should they show any signs of strength. So we're going to do a quick fire through all 10 of these because there's a lot, and I hope this offers you some opportunity to put some of these on your watch list and think about investing in them for, again, those long-term gains. So we're going to start with value stock number 1, and that is Chevron. Now they're down about 7.5% over the last year, so not a great performer. Now oil ain't going anywhere anytime soon. Oil is just not for energy, it is for many of the products that you and I use today. Many underestimate our reliance on the oil and gas industry, so I believe companies like Chevron will remain great performers for at least the next decade. Not to mention, these companies will not sleep on renewable energy either. They will adopt and adapt in these areas and are currently focused on investments in renewable energy. If we look at Chevron's net income, we'll see it's been on a downtrend, which may be why the stock is kind of suffering. But if we look at that debt, it's been going down steadily, which is so important. This can make or break a company, so I love that they're focusing on this. And those profit margins have been going up over time, holding around that 40% range, which is pretty darn good. Now with its analysis, we will see it is now an outperform rating and has a potential upside of 13.5%, and you'll see the target prices there circled in yellow. This one for me is a good long-term value play because, again, oil and gas are not going anywhere. We're very dependent on it. Now AbbVie is the next one, and this one's up about 0.3%, so it's been a flat performer over the last year. Now with this one, where I see the value, Humira, its main offering, is still showing dominance despite cheaper alternatives coming to market recently. It has a strong pipeline of offerings, including in the growing aesthetics industry. Cash flows are strong to support its dividend, and for you dividend investors, that creates security and strong passive income. So speaking of its net income, again, this one is on a downtrend similar to Chevron, but that long-term debt is also going down, a very good sign. Now the profit margins here are very strong, hovering just above 70% on average. So if we look at its analysis, we'll see it is at an outperform rating, has a potential upside also about 13.5%, and you'll see its target prices there circled in yellow. One that I think will be a strong performer due to the healthcare sector in general, expecting growth over the next couple decades. Next up is JP Morgan, one that you might scratch your head because this one's up over 30% over the past year. But JP Morgan focuses on organic expansion opportunities and its own distribution platforms, which should drive strong gains over the next decade. JP Morgan is a sleep well at night stock as you will not worry about its balance sheet strength or deposit flight issues like small banks have to deal with. It is the most dominant bank in the US, and that creates a wide moat. It's at an advantage that will propel this stock for many years. Now its net income kind of was on this uptrend, but started going down. So that could be something that might create some opportunity should any weakness, further weakness, shall I say, be shown. But that long-term debt also has been going up, so something you want to keep your eye on. But those profit margins remain strong. Overall, they're going up with a slight tick down over the last quarter, but remain close to that 40% range, which to me is good. Now its analysis, it's in the outperform range and has a potential upside of about 12.5%. You'll see its target prices there circled in yellow. Again, with the dominance it has, the wide moat, this is one that will be a good long-term performer. Next up is Merck. This is a pharmaceutical company, and over the last year, it's done well, about 9.5%. This one is heavy in the offerings of cancer treatment and has first mover advantage with its popular offering Keytruda. It offers a secure dividend and has a diverse portfolio of offerings. Another pharmaceutical company I believe has a bright future. If we look at its net income, recently it's kind of gone in the loss to the income range. So this is where we might see this opportunity with this stock should any weakness and fear come from investors. And that long-term debt overall is going up with a slight tick down over the last 2 quarters, but the profit margins on this company are beautiful, holding about 72%. So with this one, with its analysis, it only has about a 9% upside potential, but it's still in that outperform range, and you'll see its target prices that are circled in yellow. So this is one that I think you have to be patient with, maybe look for some weakness, but long term, I think this will be a great play. Next up is United Health Group. Now this company just reported and its earnings were pretty good. So you see it kind of went up there at the very end, and it's only down about 4.3% in the last year, but it's still in the negative. So this one is a business that is ran conservatively, giving it more flexibility in times of change. It's the leading provider of Medicare Advantage plans, which are increasing in popularity among seniors. This company provides medical insurance, pharmacy benefits, and healthcare services that will help clients control healthcare costs, something that will attract customers and its future growth for many years to come. To me, healthcare will be a growing factor in our world, and a strong quality company like this is a great investment option. Now, its net income overall has been going up, so that is a good thing. And then I want to look at this reported medical care ratio. This represents managed care expenses as a percentage of managed care premiums earned, and premiums are the bread and butter of insurance companies, so the fact that they're maintaining this is excellent. Now, its long-term debt overall is going up, so you want to keep an eye on that. But with its analysis, this one has a buy rating, one of only 2 on my list that have this rating, and it has a potential upside of over 30%. So one that is offering the most potential growth, and its price targets there are circled in yellow. I think this one is a company that I'm going to put on my watch list because I really do like this. I do understand the insurance industry pretty well, and I think this one will be a strong long-term performer. Next up is Procter & Gamble. I call this the company of many things. Think of Pampers, Bounce dryer sheets, Downy, Cheer, Bounty, Charmin, Puffs, Braun, Gillette, Crest. I could go on and on. In fact, if you go look at their products, you'd be amazed at how many they have that we're all familiar with. This company is focused on efficiency, which will be our best friend as investors in the long run. Now, this company is up only about 3% over the past year, so it's underperformed. With its net income, overall, it's on an uptrend. And if we look at the long-term debt, it's kind of remained somewhat flat, but overall going down these last 3 quarters. And gross profit margins are pretty strong, holding above that 50% now, but it's been growing, so that is a great sign. Now with their analysis, they're again on the low end. Their potential upside is only about 9%, but they are still in the outperform rating, and you'll see the target prices there. So for me, this company just offers so many products that we are all used to. They're household essentials. I just think this will be a strong performer long term. Next up is ExxonMobil. Now this one's up about 4% over the past year, so that's underperforming in my eyes, anything about 8% or below. Again, oil and gas ain't going anywhere anytime soon. Again, mostly the same as Chevron, but also Exxon is reducing spending aggressively, has appointed new board members which will create added change, and is heavily focused on reducing emissions. Of the two, Exxon is more focused on investing in renewable energy than Chevron. Now, its net income has also kind of been on a downtrend over the last 6 quarters. Its long-term debt, though, also on a downtrend, which is a very good positive. And its gross margins overall are going up, and it's getting close to about 35 to 40% range, which is pretty good. If they keep improving this, that's going to be a great thing for this stock. Now, its analysis, it's on the low range, probably one of the lowest ones on this list. It's about a 7.3% upside potential. It is in the outperform range. You'll see its target prices there. So for me, I almost bought into this company when it was below $100 per share. I wish I did. If it gets there again, I probably will open up a position. Again, I just think oil and gas, we're so dependent on it. It has at least a couple more decades of, I believe, outperformance. Next up is Johnson & Johnson. Now this company just released earnings. It hasn't done well since the pandemic hit. It's down about 11%, but J&J does have some specialty offerings coming out in the future that will carry strong pricing power. J&J does offer diverse healthcare segments, which creates a defensive investment for us. Their dividend looks very secure, and per one of my most recent videos, they do hold a higher credit rating than the US government, one of only 2 companies in the stock market that do, which shows its financial strength. So with its net income, it's kind of been all over the place, more on the downtrend, even had a net loss 3 quarters ago. Now its long-term debt though, overall is going down. That's excellent. And the profit margins remain very high on this. It's towards that high-end range that I like to see, closer to that 70%. Now with its analysis, we will see that it is in the outperform range. It has an upside potential of over 18%, almost 19%. You'll see its target price is there in yellow. For me, Johnson & Johnson is moving towards a range of a buy. I think if it hits below 140, I may add some. I do hold this company. I don't know if I'll keep it for the long term, but I think as a short-term play, it might be something that you might consider. Now I want to look at my portfolio, and then I will go over my last 2 stocks because they're both from this portfolio. Now I show this with every video, and recently my portfolio was above 20% in growth, so it's kind of been on the downtrend because it now is sitting at 16.44%. Of course, that is mainly due to the high rates affecting REITs, and you'll see Vici and O are both down over 7% for me, but I'm okay with that because long term, I am very bullish on those companies. But you'll see Johnson & Johnson there, it's down almost 5%. That was one of the stocks on this list. So what are the 2 stocks that I think are value plays right now? One is Health Equity. Now this is my newest stock, so be sure to check out my most recent video on this. I go over all the details, why I'm so bullish on it, but this is offering a product I feel will be widely adopted in the future and is already proving to be successful and sticky. I'm very excited about this investment, and with its analysis, this is the only other company, the second one, that is in that buy range and has an upside potential of over 22%. Now the last company I'm going to cover is S&P Global. This is a data powerhouse of a company offering essential services that institutions require and depend on, such as its rating services. It has a wide moat and is in a triopoly with Moody's and Fitch. This company will benefit from AI and is in a strong position to outperform for decades. Now it's almost in that buy range. It's right there teetering on outperform and buy, but its upside potential is over 20%. I may add very soon to this company. I'll let you know. But for a long-term play, a value play, this is one of my favorites. So let me know what you thought of these 10 value stocks. Did you like them? Do you agree with me? Do you disagree with me? Also, what value stocks would you add to this list that you can share with us so we can all create some companies that maybe we might want to pull from and put on our own watch list or buy into? I also want to provide a shout out to all my subscribers. Yes, that's you. Your support means the world to me. I love what I do and you all inspire me to keep going. I'm building a channel focused on helping us all create wealth and make better lives for ourselves financially, and I'm doing that by providing the best content I can, by constantly improving it in myself, and by doing it through honesty and transparency. So if you are new, welcome, and consider subscribing and adding an extra channel that can help you grow and reach your goals. I'm grateful in any way you're able to support my channel, from a simple like, to subscribing, to joining one of my membership tiers. Yes, I have some membership tiers and they're down in the description. Now, investing in yourself is the best investment, and my hopes is that this channel helps amplify that growth. As always, happy investing, make good financial decisions, and we'll see you soon on Mark Arnold's Finance.